You roll over now and just get back below the early year highs, and that's going to start people wondering, hey, is that real?
Yeah.
Is that a trap? And that's when the concern will, it won't take much. We're talking about 3% drop below there.
Right.
And suddenly, oops, well, I thought that was a breakout, man. Okay, you get the point.
Yeah.
And at that point, you better never, ever take out that price low we saw in April. Because when that drop started, we got bearish in January, and it took it like a month or two to finally get going. But before we got to that low, we said, okay, watch out, there's going to be a bounce point in this sell-off. And it's going to be 4,800 area for the S&P. Well, its low was 4,835. And for the NASDAQ 100, it's going to be in the 16,500 area. It stopped almost precisely there and bounced. The bounce was bigger than we thought because it made a new high. But I don't trust the high. So that's a factor to watch if you're in the gold market. Smart money has already said, hey, I've seen enough evidence that something's wrong with this stock market. Yeah, it made a new high here, but it also did. See, we called the stock market top in 2000, in January of 2000. It had a drop into February, but then it came up in March of 2000, made a new high.
Hey!
Our subscribers said, oh, golly, you're wrong.
Yeah.
It didn't go anywhere. It made a new high.
Yeah.
It plateaued for the whole year. It just wouldn't go down. But it also really didn't go up. It just held. It was topping. It wasn't until 2001 that it really started down. That's when the Fed started cutting rates, by the way.
Mm-hmm. Mm-hmm.
And in 2007, you had another arduous top where you made a peak in like May, June, July of 2007, had a sharp drop into August, just like we had into April, came back up and made a new high.
Yeah.
Fed cut rates then, by the way, to help create a new line. That was the top. But it was arduous.
Yeah.
So it really fooled people just looking at a price chart. When you look at momentum, you see the stock market totally differently than when you look at a price chart. And that's why we argue it's a top.
As election season heats up, politics is once again merging with monetary policy. Despite claims of free market ideals, policymakers, past and present, continue to manipulate money supply. Calls to slash rates to 1% or lower aren't about economics, they're about optics and control. Free money may boost asset prices temporarily, but it distorts real economic signals. This illusion has kept markets inflated for 15 years. Gold, however, sees through the fog. It knows the score. Whether it's Trump, Biden, or Powell at the helm, the result is the same. More printing, more distortion, and ultimately a reckoning.
Just part of the fact, these things come and go, what you're talking about, where the Fed changes and changes dramatically. Okay.
Yeah.
This one is the political realm to it. We know that. It hasn't been true in the past so much as now. And, I just remind everybody who regards Trump as a free market advocate, you're not a free market advocate if you advocate the central bank, in other words, the monopoly control over the commodity of money, artificially prices money well below reality. Like he wants to go to 1%. Why not free? What the heck? Let's go back to free again. That's helped the stock market for 15 years go up. It's a bubble. You print money. Money's free. It goes up. Okay. So when you look at it that way, gold knows this is coming. It doesn't matter who's the president, who's the head of the Fed. Even Powell's going to shift. And I suspect he'll shift probably in the next month or two. Because once you get a few bad data points, and I think that unemployment data, for example, is so creepy how they interpret it. Last month, for example, we had a gain of 150,000 jobs or whatever it was. Half of that was government jobs, state and local government. Okay. And then the other parts of the gain were hospitality. God, we need bartenders. I know that, and waitresses. And that's and home care workers. Somebody's got to take care of grandma. Okay. But when you take that out, the major parts of the economy were flat to negative growth in jobs. Okay. Offset by state and local government, which is the core of the economy. We know that. Okay. All right. So, but Powell takes the overall numbers as the job market looks good. Well, he's got two Fed governors already who've said we want to cut now. Okay.
Official job numbers paint a rosy picture, but dig deeper and the cracks show. Last month's 150,000 job gain, half came from government hiring. The rest were mostly hospitality and care workers. Core sectors like manufacturing and tech barely moved. In real terms, the job market is flatlining, yet media headlines celebrate growth. Meanwhile, several Fed governors are already voicing the need for rate cuts. It only takes a few more data misses, like soft payrolls or rising unemployment, for Powell to pivot. And once the Fed blinks, markets won't wait. They'll reposition fast, particularly into inflation hedges like gold and miners.
All you need is about one more, and suddenly it gets to become a chorus. And even though there's a lot more governors than three in Powell, but still, you start to get more. Another one here, another one there. Powell's going to get tapped on the shoulder by these people inside the Fed. And he's going to pretty soon have to say, these guys see reason and, this is a committee and he'll cut rates. I don't think he's going to wait till May and be some kind of political hero. So, all it's going to take is, if the stock market, for example, is topping as we think it is.
Right.
If all of a sudden we find the stock market, you're back below the prior highs. 2024 for the NASDAQ, 2025 for the S&P, the highs that occurred then. If you slip back below that, then suddenly that breakout doesn't look like a breakout. It looks like a teaser. In fact, there's one of the first books I ever bought in 75. I was working for Hutton. I didn't know anything about technical analysis. And of course, everybody then was a technical price chart technical. Edwards and McGee wrote a book in 1958 called Technical Analysis of Stock Market Trends. It's a big, thick, 400-page fine print book. Weighs about a pound. Okay, and I bought a hardcover copy. There was a financial bookstore somewhere near Wall Street. I remember walked by the front, and there was that book in the middle of the. Okay, I bought it. I still have it. They have a price chart pattern that very few people talk about. It's called the broadening top. And it is exactly what I was talking about, where when you make a top, sometimes it's confusing and it makes a new high, even after it's really started the topping process. Well, what they have is, we know what a coil is when it gets narrower, price narrows over time.
Yeah.
This is the opposite. It widens. In other words, you got a 5, 4, 3, 2, 1, 3 highs, 2 lows, and each is higher than the other or lower than the other. So it's a widening pattern when you look at price. Well, right now we're at point number 5 in that 5, 4, 3, 2, 1 broadening pattern. And I've not heard any orthodox price technician on CNBC or Fox Business talk about the chapter in the book, the orthodox chapter of technical, that defines a broadening top. I've never heard anybody say that. And yet it's a classic pattern. And it's developing not just in the S&P and NASDAQ, but I can find it in a lot of sectors, including some stocks. NVIDIA, to some extent, has that pattern.
One of the oldest technical patterns, yet rarely discussed today, is flashing red. It's called the broadening top, a formation that looks like a megaphone. Each rally goes higher, each dip lower, expanding volatility. It signals confusion, exhaustion, and ultimately reversal. We're seeing this pattern emerge in the S&P, NASDAQ, and key stocks like NVIDIA. If prices fall just 3% below recent highs, the illusion of a breakout shatters. Momentum already shows the top is in. Once price confirms, panic could set in. Technical analysts ignoring this classic pattern may miss the early warning signs again.
You roll over now and just get back below the early year highs, and that's going to start people wondering, hey, is that real?
Yeah.
Is that a trap? And that's when the concern it won't take much. We're talking about 3% drop below there.
Right.
And suddenly, oops. Well, I thought that was a breakout, man. Okay, you get the point.
Yeah.
And at that point, you better never, ever take out that price low we saw in April. Because when that drop started, we got bearish in January, and it took it like a month or two to finally get going. But before we got to that low, we said, okay, watch out. There's going to be a bounce point in this sell-off, and it's going to be 4,800 area for the S&P. Well, its low was 4,835. And for the NASDAQ 100, it's going to be in the 16,500 area. It stopped almost precisely there and bounced. The bounce was bigger than we thought because it made a new high. But I don't trust the high. So that's a factor to watch if you're in the gold market.
As equities wobble, gold miners are quietly gaining ground. Institutional money is flowing into undervalued producers like Newmont and Barrick. These companies are generating real profits, and yet their valuations remain depressed. Historically, during precious metal bull markets, miners outperform gold itself. Experts forecast miners could triple in value relative to gold within 2 years. If gold hits $3,400 or even $8,000 in a worst-case dollar devaluation scenario, the upside in miners could be explosive. This isn't just speculation, it's a reversion to value. Smart money isn't waiting for headlines, it's already rotating into real assets.
Because it'll stimulate the Fed into what they do best.
Yep.
It will cause money to flow elsewhere. I think it's already beginning. Gold miners. If you're fleeing the stock market and you don't invest in silver futures, let's say, or you don't go out and buy bullion, okay?
Right.
What do? You buy miners.
Yeah.
And I think that like the Newmont report, they just realized, hey, these guys are making money, man.
Yep.
Newmont went, which we had expected, by the way. Money's flowing into those miners. And I think it's a recognition that don't trust the stock market. And hey, we really missed something here. These guys are doing very, very well, and they're not priced sufficiently.
Yeah, it's almost a value play.
Yeah, I think it really is. And our expectation is over the next, to give you a relative gain, miners could triple in relative value to gold over the next year or two. Triple.
That would be substantial.
Now, gold's at 3,500. Let's say it goes to, I don't want to be silly about this, but it's twice before you've had 8-fold bull markets. 1980 peak was an 8-fold gain from its bear low. 2011 peak was an 8-fold gain from its prior low in 2001. If we have an 8-fold, it means $8,000 gold.
Yeah.
Whoa. Can you imagine where GDX might be if it tripled in value? Okay, you get the point. And silver could go even more berserk in terms of regaining value.
Silver miners are flashing breakout signals, particularly the SEL ETF. For nearly a decade, SEL has hit resistance around $50 until now. Momentum indicators already broke out, and price action is catching up. A monthly close above $50 would unleash massive inflows, confirming a base that's been building since 2015. Once this ceiling is broken, SEL and GDX, the gold miner ETF, could sprint toward their 2011 highs and beyond. The masses may still be watching tech stocks, but the next leg of this bull run could belong to precious metals. When the floodgates open, there won't be time to catch up.
Actually, we calculated lower than that, but I'm sorry. There was a low monthly close in GDX coming off that 2011 peak that was lower than where we are now. So we're actually above it. If you look at that low close and plot only through closes, monthly closes, you'll see it's slightly lower, meaning we're actually above it. The one that's poised right at it right now is SIL. Silver's the gold is the
silver miner one.
The silver miner ETF. It's around $50. You look at 50 on it. It peaked over the last 9 years or so since 2015, like 2016 rally, the 2020 rally. It keeps peaking at 50. This is the third time. You close a month out, and we're trading just below there now. We've been above it intra-month. You close a month out credibly over 50, and you're going to blow through even a price chart base.
Okay.
Momentum's already blown that stuff out, but price is usually lagged, and it's got the base that any idiot could draw with a line for the last 10 years and say, we just broke out a huge base. And I would argue when that happens, you're going to take out the 2011 price highs on GDX and SIL fairly quickly. August, any month that closes credibly over 50, maybe the month it does will be 55. I don't know. But it has a price base. And even, most people look at price charts. They don't look at our momentum charts. Our momentum charts say it's green light, be bullish. But when you cross that price threshold, even the price guys are going to say, Golly, I missed this. I got to be in this. And that's when the money flow, like you said, you define the numbers, it'd be massive. It's a wet bar of soap. Phenomenal.